All right, the second question is around, can you expand? I touched base on kind of rate of change and risk ranges, I believe, in episode 13 or 14. But again, you can find a lot of these questions or all these questions now inside the Hedgeye TV YouTube channel and specifically the Beginner's Guide playlist. But the second question is, please expand on the ROC, the rate of change when looking at risk ranges. So I've set up, or I've screenshotted kind of today's, yesterday's, so March 17th, March 16th, and then last week's March 10th. The way that I look at it is via day over day and week over week. The question asked about month over month, I think, although it can be helpful in terms of, like, I guess, reviewing historically, like where we've come from, the risk ranges where they're dynamic and are influenced by price, volume, volatility. I personally find that if you go out more than kind of a week, it just gets a little doesn't provide as much kind of detail or insight as one might wish, right? So, but definitely tracking day over day and week over week. Those are two things that I've talked about here, as well as on the weekly notebook review on Wednesdays. So if you aren't participating in that, that's a Twitter Spaces event on Wednesdays at 4:30 p.m. Eastern, and then that gets thrown up via podcast and YouTube as well for listens and replays afterwards. But in terms of the day over day or the rate of change, generally, if you go back to that slide 9, in terms of the day over day, you can see that the 30-year, it put in a lower low. So again, today's risk ranges are on the left, yesterday's are on the right. So you can see there from a rate of change standpoint, the top end of the range was 401 yesterday, is now 3.99 today. The low end of the range is 3.60 today, and yesterday was 3.61. So that's a lower low and a lower high, right? So you're kind of tracking these things day over day. Similarly with the S&P, you put in a higher low and a higher high today versus yesterday. Now, if we go to the next slide, Genron, this is where you can kind of get a feel for what's happened on a week over week basis. So a couple of big things transpired week over week. You've got all of your U.S. Treasuries went from bullish trend to bearish, right? So that's a huge call out. So not only is it just the ROC, the rate of change, but it's also obviously here in terms of the signal week over week. Now, you'd be watching this and tracking this when it actually happens in real time, but certainly this is one of the benefits of looking at things week over week, because you can remind yourself, oh wow, yeah, that's right. U.S. Treasuries were bullish trend just 5 trading days ago. Similarly, you can see as well, like on the we'll just go on the 10-year this time. The top end of the range is 4.11 today, and last week it was 4.09. So that's a higher high but a big time lower low at 3.38 today and 3.82 last Friday. So again, this is a core reason why this has happened is because the MOVE index, aka U.S. Treasury volatility itself, has exploded to the upside. It's up 160. Closed yesterday at 167.95. So with that explosion of volatility, the risk range is blown out as well. But again, this is like a key thing to be tracking, not only, as I said, day over day, but week over week, because it really gives you a sense as to what's transpired in the last 5 days. Similarly, down at the bottom, you can see again, ITA's moved to neutral trend here today versus a week ago, and conversely, GDX has picked up some some signal strength as it's moved back to moved to neutral from bearish a week ago. But the interesting thing there with the GDX number, again, this is a relative correlation to the volatility environment that we are experiencing here a week later. That risk range has a lower low at 25.88 today versus 26.13 last week, and 30.30 on the upside to 28.72 on the top end of the risk range last week. So again, that risk range has widened. The signal has turned to neutral. And that from a rate of change standpoint, that top end of the risk range is almost a little less than $2 higher than it was just a week ago. So these are all things that I track, I watch, I kind of write down and evaluate. And then the other thing too, as I'm looking through this, if I'm kind of correlating this back to that first question, When you're looking at the price from the price component, so that look back window, understanding where the top and lower end of the risk ranges fit into your look back window in terms of like the high and low pricing. So I've quoted this before, both in the arena and on Twitter, et cetera, et cetera. But if I say something, or if we say something like a 1 month high or 1 month low, this is where and that if that risk range is above it, then that means there's a higher probability that you're going to be making new highs. So a positive or really strong signal is going to be one that's making higher highs and higher lows in a bullish formation or bullish trend. And those higher highs and higher lows are, and when we say that is because it's the low end of the risk range is above the 1 month low, and certainly and hopefully the 3 month low. That's kind of typically how that would work. And then a higher high is the same thing. It's above the most recent 1 month high and the most recent 3 month high. So these are all things to be tracking and to be watching.